Hey everyone, we've got a jam-packed episode today with some great insights. We'll have a Perth property market update and what we're seeing on the ground. We'll have a discussion around second-tier lenders and their pros and cons. And we'll also be talking about cash buffers, not only for investors, but also for home buyers. Today, Vish is joining me. How you going, mate?
Good.
Should we get straight into it?
Absolutely.
All right. Give me the current state of the Perth property market.
So I think just a few key points. First things first, at present there's approximately 6,000 properties on the market for sale, which is a little bit of an uptick from what we saw a couple of months ago. In addition to that, it's taking slightly longer for properties to sell, approximately 14 days plus or minus. Again, a slight uptick.
I think that's an important note to make.
It is.
Slight uptick.
Yeah, exactly right. And it's probably important to note that both of these metrics, whilst they are slightly increasing, they're still well below where it needs to be for what's referred to as a balanced market.
Exactly right.
So I think a balanced market needs to be roughly 13,000 properties in the market for sale, and 14 days median plus or minus to sell is still incredibly quick.
Yeah.
But it's just a comparison, right?
Yep.
So, and the other important thing to note is that given that there is still quite low supply and properties are selling still relatively quickly, albeit a bit slower, property prices in Perth are still increasing, albeit at probably a slightly lower growth rate than what we've seen in the last few years. And the general expectation is that's probably just going to continue, but again, at a slower rate.
Yeah, good to provide that comparison, I think, given the nature of the market at the moment.
Exactly. And I think it's just important to touch on that as well, that we're referring specifically to Perth in these metrics. So if you hear wider commentary in the market for properties over east and whatnot, it probably paints a very different picture.
Sure.
So I think people just need to be aware of what they're reading and what they're hearing and bringing that into context.
Yep. Yeah, Australia has different markets statewide. So
Exactly.
Today we're specifically talking about Perth. So
Correct.
yeah, really good notes there. So what are you seeing on the ground then?
Yeah, so I guess, with the rate rises that we've had this year, borrowing capacity has obviously taken a little bit of a hit, especially for our owner-occupiers and investors as well. But on top of that, with what's happened recently since the federal budget and the proposed changes to negative gearing, a lot of lenders have actually removed negative gearing from their calculations. Now, that's even before it's been legislated. It's highly expected that it will be legislated and these changes will come into effect for the mid to longer term at least.
Yeah.
So with the removal of negative gearing, it's had a massive impact on borrowing capacity for investors. So I think all of these, or a couple of these things combined, is directly leading to a few of those softening conditions in the Perth market and obviously Australia-wide. So we'll just have to wait and see.
Just
what
on
happens.
the negative gearing, do you just want to point out what it's been removed for? So there is, I guess, a criteria, just so when we are talking investment and the reduction of capacity, what type of properties can you no longer negatively gear?
So it's exactly in line with the proposed changes by the federal government. So basically any established property that gets purchased or that went under contract after the 12th of May, negative gearing will no longer be applicable. Obviously, any properties that were purchased before the 12th of May, negative gearing can still be applied. Another scenario we can talk about is if you own an existing home or owned an existing home before the 12th of May, and then after the fact, you buy and move into another owner-occupied property and convert your existing to an investment, you can apply negative gearing on that. And then thirdly, any new builds that falls under that criteria, there is a strict criteria, which we won't touch on, but as a generic rule, if it's a new build, you can also apply negative gearing onto that.
Yeah,
so
well.
There's a few changes in there, but it's still a watch that space. But the banks were pretty quick to move on that, just to ensure that from their perspective, they were, or at least they feel like they're obliging with responsible lending obligations.
Yep.
And I guess on the ground, like we were saying before, it is still, I would say, based on experience, still quite hot. Not as hot, but your owner-occupied stuff in your blue chip suburbs, desirable suburbs, you go to home opens on the weekend and there's still lots of people there. And I think that will probably continue because if you think about that owner-occupied space, some of these changes aren't as relevant. People still need a home to live in. People are still chasing these better suburbs, schools, amenity. That doesn't just disappear overnight.
Yeah, really good point. So with the, I guess, given the slight softening in the market, should people still go out and buy, or should they hold off?
This is a loaded question, Dill.
Of course it is.
People ask us this all the time, and I think we have to be very careful in the advice that we give, because at the end of the day, we don't have a crystal ball. We don't know exactly what's going to happen. Things can change overnight, like we've seen, right? So generic advice is, if you are holding for the mid to long term, then it's kind of irrelevant, right? If you've got a longer term view, property markets are cyclical. We understand that. They go up and they go down. That just happens. So if you're holding for a longer term, when you buy is kind of irrelevant. The other thing that we always kind of try to advise people is that, should I wait? We don't know, right? We don't know what's going to happen. So if you're in a position to do something and you feel like you want to do something, or there is a wider goal in terms of wealth creation or whatever the case might be, then go for it.
Yeah.
So, but like, I understand that question because obviously people don't want to be in a position where they purchase and then within a year or 2 years be in a negative equity position.
Mhm.
That's never ideal. But again, going back to the point about longer term, it's kind of irrelevant.
Yeah, long-term view is always critical, and I guess talking with your advisors, we're going to be talking about cash buffers in a little bit, but that's part of the overall advice we give is have that long-term view and make sure you're set up to hold with the market as it moves.
Exactly, and I just really want to reiterate the point that we just discussed before as well about markets being contextual. So it's really understanding if you're operating or looking at a specific market, understand that market and don't necessarily listen to the wider commentary.
Yeah.
Right. So for people in Perth specifically, if they're listening to the news and the property markets are set to dip 10%, 15%, 20% over the next couple of years, maybe just do a little bit more digging because I guess in Perth specifically, yes, it may not grow as much as it has, but is it likely to drop 10 or 15%? My personal opinion is very, very unlikely. Again, time will tell, but just be careful what you're listening to.
Yep. No, really good insight there. So we've spoken about people's borrowing capacities reducing, maybe because of rate rises, all these changes for investors. So when we're talking, other options, we might look at some smaller or second tier lenders because clients are looking for more borrowing capacity or better deals.
Yeah.
What is a small lender and why do clients go to them?
Yeah, so in Australia, kind of by definition, you've got your big four or your big five now. So you've got your NAB, Westpac, ANZ, Commonwealth Bank, and Macquarie is very quickly joining that pool. It's not officially termed that yet, but it's quite known in the market. Anyone outside of that is basically can be considered tier 2, tier 3, and then you've also got your non-conforming lenders as well. So just to give you some examples, your Bankwest, your Resimac, Firstmac. I'm just shooting names out.
All lenders we've used plenty of times.
Exactly right.
And clients see great value. So
exactly.
People may have heard of them, may not, but all been used plenty of times in the past.
Exactly right. So that's typically how we define them.
Yep. So how are they different to the big four then? Or the big five, do you want to call it?
Yeah. So there's different things. First things first, every lender is different, right? Even within the big four, they're slightly different in the way that they view things. And then obviously outside of that, it's completely different. So typically speaking, your second tier, third tier non-conformings, they may have more favorable servicing policies. In instances, they may have better rates. They may have cheaper fees, and then policies is the main one really. So just so to give you an example, some of your second, third tier lenders, APRA have regulations where that forces the banks, especially the majors, to have a 3% buffer on top of the interest rate that a client is actually paying when they're calculating borrowing capacity, whereas some of these second, third tier lenders may only go with a 2% buffer. Now, that may not sound like a lot, but we've seen it. It makes a huge difference in borrowing capacity.
Yep.
So, yeah, it's just a few little niches
Yep.
that they will find, which then makes it more applicable to someone's situation.
Yeah, spot on. So we have been using them. So in what instances have we been using these for our clients?
Yeah, so chasing borrowing capacity.
Yeah.
You know, in more recent times, just to be quite topical, where someone's all of a sudden lost the ability to negative gear overnight and their borrowing capacity has dropped $150,000, going somewhere where we're only applying a 2% buffer, they may not recoup that full 150, and they may only recoup $50,000, $70,000. But again, that's one way of looking at things. I guess this is the other thing that's important to note with these second tier lenders is that, you know, it's a bit of a catch-22 because sometimes they may have lower rates and lower fees, but typically speaking, you're going to these sorts of lenders because you're trying to find a specific niche, right?
Yeah.
With that may also come slightly higher rates and fees. So it is very, very case by case. And depending on what client's looking to do, we'll basically determine which sort of lending market we're going to push them towards.
Yep, just the opportunity costs, especially for the investors.
Exactly.
Having that additional borrowing power gives them the opportunity to get what they're looking for.
Exactly right.
So we've spoken about serviceability. How about maybe for like credit impaired applicants where they think they've got no option of buying, but these second or other options are there for them as well.
Exactly right. So impaired credit, that's one of them. We obviously don't like or don't love to see people at impaired credit, but it does happen sometimes just by accident, really. So, typically speaking, your big four probably wouldn't touch them. Whereas, your second, your thirds probably will. Again, it's coming at a slightly higher cost and rate, but again, it's an opportunity cost to get into the market. We've touched on specific policies. I think I just talked about the buffer. There may be specific policies where, again, typically speaking, your big 4 or 5, they want to see a self-employed person has been self-employed for a couple of years, 2 years, ABN registration, so on and so forth. Your smaller lenders may basically just go, you know what, even if you've had a 6-month ABN, we'll consider that. We'll look at your BAS statements. We'll extrapolate that income and we'll see what you can borrow. So all of a sudden, instead of having to wait 2 years, you're in the market in 6 months. Again, probably at a higher cost in terms of rates and fees, but that's just something that we've got to weigh up. In terms of other specific sort of niches, other incomes that may not be considered, we're talking child support, child maintenance, Centrelink payments,
and how they're assessed.
Exactly.
What shading they may or may not apply compared to the big four.
Exactly right. Even simple things like bonus income. Your majors will automatically shade that down to 80% of what they're worth, generically speaking. Your second, third tier lenders may not actually apply any shading on that. Depending on how hefty your bonus is, it can be quite a significant impact. So that's just something that we take into account in all situations. I think I touched on the fact that, the big four, especially a big 5, they're bound by a lot of rules by APRA. Obviously, the banks are highly regulated. The second, third tier lenders obviously have to operate within specific metrics, but the regulations of these metrics may not be as vigorous as the big four. So it gives them a little bit more flexibility and space to play, which then may attract specific clientele.
Yeah. Really good there. So to round that out, what are some pros and cons of these type of second tier lenders?
Yeah, I mean, the pros is obviously maximizing your borrowing capacity means you may be able to buy that dream home sooner, maximizing borrowing capacity so you can actually get into the investment market. I don't think we can underestimate the pros of that. I mean, if we look at property over a longer term and the wealth that can create, if you can get in sooner, especially in a rising market, you might make a couple of $100,000 over a couple of years. Sure, you pay an extra, whatever it is in interest, but if you weigh that up, you probably come out ahead. The important thing to note is that these are just potentially just entry points as well. So if we talk about your self-employed person, sure, you're paying a higher rate for, after the 6-month period, but once you've had that 2 years, there is absolutely no reason, assuming business performance and stuff is strong, there's no reason why you can't then move out to a major and get that rate down, get back onto sort of lower fees. So, but again, it's just dependent on an individual's risk appetite and how they feel about these things before a joint decision's made to go into. But I believe that's a big pro.
Yep.
The cons obviously is the cost.
Fees,
but again, it's weighing that up over a shorter term. Just going to the pros as well is that sometimes the second or third tier lenders don't necessarily, like I said, have to warrant these higher costs and fees.
Yep.
They may actually match the big four. So if you can match fees and rates whilst getting higher capacities and whatnot, that's obviously
makes sense.
A major pro. Cons, a lot of these lenders probably don't have as much of a presence in the market. So your majors and whatnot have got really good, they've got branch presence if you need them. They've got really good online banking platforms, really good customer service in terms of picking up the phone and making a call. Your smallers, whilst they're not horrible, I'll be honest, they're just not as good.
To be expected, I guess.
Yeah, exactly. So their apps may not be as good. They may not be able to just pick up a phone and get on the phone with someone within 20 minutes. But again, it's important to note that in the digital world that we're moving towards, there really ideally shouldn't be a requirement to be doing too much maintenance.
No.
We want to make sure that we're setting things up at the start so that a lot of it is automated and you don't really need to think about it. Another con probably, which is a major one, is that some of these products at second tiers or third tiers don't come with your offset accounts.
Features.
Yeah, the features of a loan that a lot of people are chasing.
Yep.
May not come with a redraw. You might need to pay for a redraw. So again, these may not be relevant to some people's specific requirements. So we'll just take it on a case-by-case basis.
Yep. No, thank you for that. So as a homeowner, let's say you're lucky enough to get into the market as an owner-occupier and investor, we always talk to our clients about cash buffers. So what is a cash buffer and why is it important?
A cash buffer is basically just a fund that we recommend to all clients to put aside, basically to save for a rainy day, right? So as an owner-occupier, if things break in the house, if the aircon goes kaput, if the hot water system goes, you just want to make sure you've got some cash there available to basically fix that problem, right? In the case of a home buyer, you want to have a cash buffer. You don't want to basically put away all of your savings just to get the deposit and your costs done. Because you also need to think about the fact that you're about to move into that property. What are you going to do in terms of furniture? Setting things up so that it is actually a home for you. And then obviously for your investors as well. That's very relevant, right? For vacancy rates. Again, if something was to go wrong, the ongoing maintenance of the property, tenants are pretty good at pointing out problems. So you want to make sure as an investor, you've got some cash there ready to go.
No, really good. And I guess, for homeowners, investors, having that set aside,
Yep.
maybe in an offset account or having those features is what we'd look at. Or, we also see for our sophisticated investors, they might put cash in other assets and then have it there for other needs. So there's a wide variety of options.
Exactly.
But you've brought up a really, really good few there.
Yeah.
What is a good size cash buffer then?
Tricky one. I think it's really just dependent on probably the value of the property, the age of the property, location. I think a few of these factors will come into what sort of cash buffer you need. I mean, if you're living in a $5 million house in Dalkey, then you're probably going to need a little bit more of a substantial buffer versus, if you're living in a $400,000 property. I'm not going to name any suburbs just in case we've got anyone listening from specific suburbs. But if you're in a $400,000 property, then your buffer may not need to be as high. And probably don't need to explain too much into that. Probably add a little bit more of an additional buffer if you are an investor, I would say. On top of that, irrespective of those few points, just because things are more likely to happen.
I guess for investors, we might say, maybe a couple of months of vacancy.
Yeah.
So as a ballpark. So what are you getting per week in rent? Can you, if for whatever reason the tenant leaves, can you cover those repayments for a couple of months? Is sort of a range, but as you said, it's case by case.
Exactly.
But when our clients come speak to us, we'll know their position, so we'll be able to give them a relative figure based on their position.
Yeah, and for our first home buyers, obviously we understand that the market's tough, prices are quite high, but yeah, again, you don't want to drain the bank account completely. So if you're moving into your first home, try and keep aside 20 grand. As a really rough gauge, just to think about your furniture and your washing machine and your fridge and stuff like that. It doesn't necessarily need to be brand new either. Can be off marketplace. There's lots of good stuff on there, or Gumtree, whatever the case is. But just making sure you've got that thought in your head that I've got this buffer there, just so that I'm not going into an empty house.
Perfect. Some great insights there. Thanks for joining me today, Vish.
No, thanks for having me, Dylan.
And thanks everyone for listening. We'll see you next time.